Go ahead. Thank you for doing this, by the way.
So thank you very
Mazen.
much. No, it's my pleasure, and thank you for the for the platform. So obviously, you and I have known each other for a while. We met initially on Twitter, initially talking about the general Lebanese economics, went on to global financial issues, among other philosophical topics. Then I joined some of your courses, which I really enjoyed. And then as the world progressed, I thought it was a good chance for us to have a wider discussion that has to do with philosophy and a little bit of business. My background is I'm a managing director at a bank. I'm a career professional trader, but more importantly, I'm a guy from Saida that left to explore the world back in '98, and now living in Dubai for the last 12 years and 10 years before that in Canada. I do, as you know, I'm doing my doctorate in business psychology, which we can later discuss the value or no value of.
Useless.
I think I have 2 more years to prove its usefulness or its uselessness. Time will tell.
Been there, done that.
I think the point of this discussion is, if you look at the state of the world for the last couple of years, if you're looking at the Earth from up on top, and you look at a world where we're hit the massive pandemic about a year and a half ago, the world was about to collapse. Unemployment was all over the place. Uncertainty was killing us. Yet at the same time, you look at what's happening in the stock market. The stock market is on fire. So you have this state of affairs where on one end, the world is falling apart. The individual is having a massive crisis at the individual level or at the societal level. But then again, you look on the other side, and the world looks really, really good. You have Bitcoin, which is a cryptocurrency, which is now worth $64,000. A year ago, it was worth $7,000. You look at Tesla, which is now worth $700, maybe $750 or $800 as we speak. So it looks like we're in a state of schizophrenia as the world. And the majority of my social settings are as such. I sit with friends I know. The first half an hour of the meeting is, I'm worried about my job. I feel I'm going to lose it. It looks like my employer is going to go out of business. That's the first half an hour. The second half an hour is, do you think we should invest in Bitcoin? Should I get in onto the next IPO? What about this SPAC? Should I invest in ETFs? So it is two extremes happening at the same time. And the world is becoming full of scams and frauds and FOMO, fear of missing out. Everybody's getting sucked into it. So I thought maybe it's time for us to have a chat to explore some of these topics that people are getting into, some of these fears of missing out that people are jumping in to investments or to opportunities where they're not really exploring. The average person is putting in $5,000 in a stock, but they take more time researching their next cooking pan. They take more time doing due diligence on a cooking pan than they do on buying a stock. So it doesn't really make sense. The last time I saw that, I think, was in the year 1999 or 2000 back in Ottawa, and then the world exploded afterwards. But then again, the market comes back. Memory is becoming shorter and shorter. Our resistance or our tolerance for risk is getting higher and higher. So I don't know where it's going to end, but definitely, there's more to be said about this topic. So I have absolutely no format for this talk. I want, on purpose, we said we're going to do it between me, who's a business person, and you, a philosopher, because number one, you have absolutely no idea about business. Philosophy teacher, because number one, you have absolutely no idea about business, clearly. You have absolutely no interest in banking, clearly. And it doesn't look like you have any interest in money.
Clearly.
Your t-shirt.
I am
clearly
effing unemployed.
So there is absolutely no better person to have this discussion about business
than your average Mo, not Joe, in this case.
Well, I don't know. I think way below average. But so
yes. Well,
so let's get going with that.
for being much way below the average. I mean, I've been monetizing philosophy for the past year, so I can offer an insight or two as well. I mean, people are buying into this shit, so something good I must be doing.
So it tells you the state of manic that we are in. People are paying money to buy philosophy courses. Yeah. That is one of the that is one of the reasons that these things have to happen. You know, yeah. But in all honesty, we had the first podcast I did was with you. I think it was year or so back. And we talked about the possibility of your platform and how your platform can actually grow, because you are providing a service that universities don't anymore. And we talked about the actual value of universities. But I think I don't want to go off topic, but I'll keep it there. And I want to leave the questions to start open to you and any other questions that we can get from the audience. And then we can build on that and see where it takes us.
Yes, and in fact, and I don't want to get into the Lebanese situation here, but because I remember from the existentialism course that you took, which was the first course I gave last June, and we were discussing about how people just put their money in Lebanese banks, and some people, including maybe you, were defending that, well, they didn't know any better, they couldn't maybe know any better, and some people were saying yes, but then the onus is not on these people to know what they're putting their money in or what they're betting on or investing in. It's on the banks, on the financial institutions, etc. So now it's kind of, we might be realizing that it's important to know at least a thing or two before we put our money somewhere.
Absolutely. Yeah.
Yeah, it's just interesting because some people really were defending, you know what, but then it's the bank. It's maybe it's the same thing when it comes to stocks. Before I ask you about stocks and all these things, it's like, first things first, right? Why should we care about this stuff? Why not trust whomever comes our way and says, you know what, just give me your money, next year you'll make 15% on the whatever.
Well, I think it all goes down to the basic principle of risk and return. Okay, just like anything else, it has to be balanced. And history has given us enough of an education for us to learn some basics. Historical return, for example, on the stocks is about 6 to 9% on an annualized basis. For example, if you look at something like bonds, they give you 4 to 6%. The banks right now give you 0 to 2%. So these are the averages. So when somebody comes and tells you, I'm going to be able to provide you 2% every month, or I'm going to give you a guaranteed return of 10% or 12% or 20%, that should automatically trigger alarms in everybody's head, regardless of where you're living. Whether you're living in the farthest point in Asia or South America or anywhere in between, there are some fundamentals right now that every person should be aware of, and then it all goes down to risk and return. The problem is, as individuals, we always tend to think that we might be a step ahead of the rest. We might think that, oh, this opportunity is exclusive for me, I don't want to miss it out. I'm onto something here, so I'm going to put my money and I'm going to let it roll. Everybody, if you ask the average person, do you think you're smarter than the person next to you? On average, they're going to say yes. So what does that happen? You ask 10 people, are you smarter than average? I'll guarantee you 8 out of 10 people will say, yes, we're smarter than average. Well, guess what? Half of them are wrong, because not 8 people cannot be smarter than the average, right? 5 have to be higher, 5 have to be lower. And that's the problem. And that's exactly what the fear of missing out comes into play. Somebody comes to you with a stock proposition, you're going to think, well, you know what? If I don't take that stock, somebody else is going to buy it and is going to make the money out of it. And that fear of missing out, that greed factor kicks in, and we end up losing collectively unless we do a little bit of due diligence, unless we do a little bit of understanding what it is that we are investing in. Just like any other business, stock market or trading or investing is just like any other business. You know, you don't watch a YouTube video and go and perform brain surgery, right? You need to have a little bit of a groundwork in it. It's the same thing. It's even doing a manouche needs a little bit of groundwork before you go and and do it. Manushi, for those that don't know what a manushi is the original pizza. Then the Italians took it from the Lebanese.
Oh, there comes the Lebanese with their arrogance as well. But yeah, no, seriously.
We need to keep something.
Where do you start, right? Like where, as seriously, I'll take the position flat out of someone who doesn't know shit. And because I told you, I've seen many videos, they start with, 500,000 and 1 million. No, I'm not interested in that. Start small. Someone who doesn't know shit, what should I do?
Okay.
Because the options are so many, right? Like if I would think to myself, should I start a business? Should I invest in a stock? Should I buy bonds? So what would you say? What would you tell someone who doesn't know anything about anything when it comes to business or investments or anything? I just have some money on the side and I don't know what to do with it.
Okay, I'd say the first thing you do is start learning basics. So what do I mean by the basics? Okay, put it differently. Anybody who, that is my opinion, anybody who has less than 2 years of cost of living saved up should not be thinking about investing. Okay, for me, this is hard-coded. That is number 1. 2 years of cost of living. So the same way you are living right now, multiply that, your monthly cost, multiply that by 24 months. That should be the minimum that you need to have as cash. Only after you have that number saved up, you can think about the prospects of investing. Obviously, you have to adjust that number higher or lower depending on, let's say, for example, okay, if you live in a country where a government provides you with everything, like Canada, for example, or Scandinavian part of Europe, for example, okay, no, maybe less than 2 years. But you have to adjust higher or lower depending on what other facilities that your government provides. But let's assume 2 years. Once you have that 2 years, then you can start thinking about different investments. The first investment which comes to mind, okay, you have savings account, for example, which I'm not going to really talk about, but because what is a savings account? You put your money in the bank pays you some interest. If you're in a decent country, you might get 1-ish%. Stocks are the first thing that comes to people's minds, especially that over the last couple of years, you hear a lot of stories of people making bundles of money in stocks. People that have bought Tesla at $50 or $70. Tesla was, I think, $80 in the beginning of 2020. If you buy Tesla, $800 or $1,000 worth of Tesla in the beginning of 2020, right now it's gone up by 10 times. So you might want to buy Tesla. So I think the first thing that anybody should do is ask a simple question. What does it mean to buy a share of Tesla? Okay, so I'm buying a stock. This stock costs me $800. What does it mean when I spend $800? Okay, I'm gonna call it spend at this
Tesla
stage.
Now. I'm the boss.
You're the boss of Tesla. So what does that mean? So what you can walk into Tesla showroom and get Elon Musk from his ear and like snap his ear for not making enough money. What does it mean to own a stock? I think that's a fundamental question. That if you cannot answer that question, don't even bother getting into a stock market. Right? You might as well throw that money away because chances are that is what is going to happen in the end. Second question is, if I buy Tesla, what would make the price go higher? What would make the price go lower? Why would that interaction happen? And what rate of return should I expect when I buy a stock, be it Tesla or otherwise? So that is the groundwork. Now, we are to a certain extent limited on time. So what I'm trying to do is try to get people to be a little inquisitive. And then if we get traction with some of these topics, then we can think about either elaborating on them this time or next time.
Yeah, tell me.
Okay. So what is a stock? Let's explain that basic concept. Okay. Companies start off as small businesses. Let's say Decaf Quest. You start as a small business in Beirut. You're the owner. And then you get a guy like me who starts speaking on your podcast and then eventually you become a show and you get other people that want to get involved. And you say, you know what, I need to scale. This business has potential. I want to grow. So you register yourself as a corporation. You become a company. What it means when you set up as a company is that the company becomes, it's like a new baby. You create a new entity. This new entity, you call it Decaf Quest Inc. That new baby, you give it a name. It is separate from Mahmoud. Okay, you own it, but that company it has its own identity. All right. So now you've set up a private company, and you are the manager. You appoint yourself as the CEO. You know, Decaf Quest Inc. is doing well, and you're getting. You say, okay, I'm going to give you 50% of the ownership.
You can't hear you.
Hello?
Not sure it's me or you. Yeah, it's him. So it's Mazen's connection.
Once you grow as Decaf Quest Inc., still?
No, it's good.
Okay. You decide to start growing your company from an entity which is owned by you, and you want to go global. How do you go global? Going global is the process by which you transfer your company from like a one-person owner company to become a public company. Public company means you want the whole public to be able to invest in you. How do you do that? This is what people call the IPO, the initial public offering, and this is how the shares get created. You go, you go to Goldman Sachs. Goldman Sachs puts a valuation on you, and then Goldman Sachs will start selling shares in your company, and those shares get listed on an exchange. Those shares, like Tesla shares, are what the rest of us as the investors start dabbling in. That's how a company is created. Okay, and this is the concept of formation of a share price.
And so, fair enough. And then if I want to buy like GameStop and these kinds of companies, how would I know that a company is doing well? How do I know that I'm going to be investing my money and I'm not going to be losing any? How do I know that things are going to be going well?
Okay, so when you buy a share in the company, what you're buying a very tiny percentage. So if a company has 100 shares and you buy one share of that company, you own 1% of the company's shares. What that means is that as the owner of that one share of the company or that 1% of the company, you have a claim on 1% of the profits and the assets of that company. So if the company makes $100 of profits and you own 1%, then you technically get 1% of that profit over time. So you get $1. Okay. So what do you want to do? As an investor, you want to buy shares of companies that have a high propensity of making profits in the future, because that is the only way you make money as a shareholder. How do you make money as a shareholder? You buy a share. If the price of the share goes up, you make money. Why does the share price go up? The share price goes up because other investors believe that the company will generate higher profits in the future. So that cycle results in the share price going higher or lower. If you don't like what the management is doing, then you vote them out collectively and you change management, and you keep doing that till the value of the share goes up. You make money as the shareholder. You end up selling the share or keeping it depending on the prospect. So it is a game of supply and demand. It's a game of psychology, but in the end, it is a game, especially at the individual investor level. As an individual investor, you don't really know what is actually going on, just like politics. You know what's in the newspaper, you hear the rumors, you get tips from your uncle, but in reality, you know what they want you to know. It's the same game in financials, it's the same game in the stock market, it's exactly the same name.
and Anna asked the question, I'll go over it just shortly, but then it's ultimately, why would you, again, as someone who doesn't know anything, why would I put my money in a stock whereby I know absolutely nothing about the innards of the company, about the what is really actually going on? So the difference between, if I have a business, I know what's going on, I know whether or not I'm going to be making money or not, but how do you know that the company is actually making money and it's not just cooking the books and, you know?
Okay, so that's why
that's kind of.
Well, for two things. Number one, you know, there's an old saying that let your money work for you. Okay, and everybody wants their money to work for them. Everybody focuses on how to invest their money, and I think there's a very big gap in that. You know, people tend to spend 80% of what they earn, and they only tend to invest or save 10 to 20% of what they earn. The problem is, people tend to forget that your net worth is equal to your earnings minus your expenses. Everybody focuses on how to invest my money. The problem is, if you focus on the 80%, how to spend my money, you will, I guarantee you, you will end up making more money in terms of a return than any investor on Wall Street. Think about it. Most people own credit cards. Many people end up missing payments on their credit cards. Many people pay fines. Many people end up paying late fees. The rate of return on bad expenses is many times higher than the rate of return on your best investment. Put it this way. If you have a $10,000 credit card and you don't make your payments on time, your average bill on that credit card, your average fees, late payments is around $3,000. That's 30%, $3,000. If you have a portfolio of $50,000 invested on Wall Street, $50,000 of invested portfolio, your historical rate of return is 7%. That's $3,500. So what is easier? Managing a credit card properly and not allowing it to go unpaid, $10,000 credit card, or figuring out how to invest your $50,000 and making 7% and not making mistakes. Obviously, managing expenses. 80%, the average individual spends 80% of what they earn, yet they don't take enough time managing the 80%, but they're always looking for the next hustle to be able to properly invest the 20%. And the problem is, instead of making money on the 20%, they follow the trades or they follow the opportunities that are way out of reach, that eventually they'll end up caught in the game of trading instead of investing, and they end up even losing. So the point is, if you want to invest and you don't know what you're investing into, like I said before, don't pick individual stocks. If you insist on buying stocks, go into stocks or markets that you understand. Okay, so I work in a bank. Okay, I work in trading. I work in financial management. If I were to actually properly invest and do due diligence, I might go into the industry I understand. I look for companies that I understand. I can see their potential. I can look at the bio of their management and figure out whether they actually are onto something or not. Same as in your industry, for example. You know, there might be a new institute or new business which is offering online courses. You might say, okay, you know what? I'm going to try to go after this industry. Let me dig deeper. I understand this industry. I can tell whether company ABC has good prospects of making money. You'll have a much better chance of making money this way rather than going and putting your money in Tesla just because your neighbor end up making a 50% rate of return. That's what I mean by due diligence. Going after what you understand.
And in this case, I think this ties back with Anna's question. What is evaluated? The value of the company at current stage or the prognostic of the company's future?
The answer is nobody actually knows. Let me tell you why. There is one of the gods of valuation is a professor at New York University. His name is Aswath Damodaran, I believe. And he was somebody I always used to read on when I was back in university back in 2001, 2002. And back then, everybody believed that what this guy said was religion. If he said the company's share should be worth $50, it's worth $50. And they used to look at cash flows and multiples and all kinds of fancy words. Okay, his models made some sense. But then you look at companies right now, like Google or Amazon or any of the tech companies which are around, and you try to, you look at something called earnings per share or earnings multiple. And what is earnings multiple? Or let's say a share price is worth $100. I'm going back to the question. A share price is worth $100, but the earnings per share, which means for every share the company owns, it makes a profit of $1 per share in a year. Okay, so you are buying $1 per year and you are paying 100 times that. So your share price to earnings is 100 times, which means all else equal, it's going to take the company 100 years to pay you back the money. Okay, which is just out of this world. Okay, some companies trade at 1,000 times multiples. So what should you look at in the near future, or what should you look at in the valuation realistically will depend on your time horizon. Okay, look, right now, why are you buying Bitcoin at 64,000? It has absolutely no earnings. It has no chance of making any earnings. So why are you buying it at 64,000? Why is gold at 1,005? What is it now? 1,750. Why is gold at 1,750? Okay, who buys gold anymore? 20 years ago, somebody has a gift, you buy gold. Somebody graduates, you buy gold. Somebody gets married, you buy gold. Somebody gets divorced, you buy gold. Okay, so it had some kind of cultural value. Central banks used to keep hoarding on gold. Portfolio managers bought gold. But right now, who actually uses gold? Why is the price still 1,750? Okay, so a lot of these valuations, a lot of these technicals that we read and we look at, you're going to find two sides of the story. One person will tell you this makes sense. One will tell you it does not make sense. Again, exactly like politics, exactly like economics, you're going to find two different opinions.
You guys are worse than philosophy people, because at the end of the day, at least philosophy people tell you they don't know. You guys claim that you know.
Well, we have to claim that we know. Otherwise, we won't get paid, right? Yeah. So if we don't claim
Watch out, I'm kind of dragging you down with me. You're gonna be fired tomorrow, man.
So no, but I'm getting to the point here is that really what you want to invest in, when you want to invest one step ahead of instead of the average population. That is the only way to make money. If I believe that that the majority rather than the minority will wake up tomorrow and decide to buy X, I want to buy X before them. Okay, that is the guaranteed way of making money. Obviously, it's easier said than done, but that is what let's say financial psychology or behavioral finance teaches you. You have to try to find the trend. And once you think that you found the trend, you want to jump in on that trend. Even that tends to be a risky proposition. So it all comes down to, if you were to invest as a non-professional trader or non-professional investor, the best way for you to invest is to buy what we call funds or ETFs. Okay, that is called passive investing.
What the hell is that?
So there's two types of investing. Is active investing, which is trying to time the market, buy and sell, buy low, sell high, find an opportunity, blah, 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 buy and sell. That's called active investing. Okay, try to pick up chances. The other type of investing is called passive investing. What does passive investing mean? Passive investing means that history has shown us that the global economy tends to grow over time. Okay, simple. Industries grow, technologies grow, number of consumers grow, on average, over time, GDP and economies grow. So what do I want to do? I just want to bet on that steady growth. So instead of trying to figure out which stock to buy, I just buy the whole stock market. Just buy the whole goddamn thing and wait. Okay? So this way, you are not betting on Mahmoud or Decaf Quest to make money. I'm betting on the whole online educational industry to make money. If I feel that the trend over the next few years, over the next 10 years, is that people are going to be moving away from campuses, brick and mortar type of educational institution, and they're moving on to online learning, if I believe that is the trend, if I believe students don't want to pay $100,000 for a business education that is generally worthless, and they're going to move on to 6-week or 12-week or courses that they can buy online, and if I think that's the trend, I will invest in that trend. I will not pick a single company. I'll invest in the whole sector. Now, the only way to buy the whole sector is you buy something called an ETF, an exchange traded fund. What that is, it is a pool of money. So all of us on this call will put our money into this pool, and the pool or the fund manager will go and buy all the companies which operate in that sector. So this way, we don't have a single stock risk. Okay, that is an ETF. So you find the stock, you find the sector, you buy the whole sector. And I saw somebody right now ask about the ARC, the Cathy Wood fund, I think.
Woods, yeah.
Yes. So what is she really doing? Okay, what is happening in the world right now?
For those ignorants like myself, I don't even know what that is or who that is.
So she's a fund manager who's been. They have an ETF, and that ETF invests in a whole bunch of technology. She's betting on technology, space, all kinds of like crazy Elon Musk type of operations. Okay, and she made a lot of money. Her fund made a lot of money, and she was called like the god of investing for a while. Then she came crashing, and now it's recovering. It went to 180, then down to 100. It's just all over the place. But there's a question that needs to be answered before that. Why is that even happening? Okay. Why is that even happening? When the crash happened, when the pandemic hit hard in March of last year, the market crashed by 30%. And everybody thought, oh, damn, the world is crashing. It's all going to end. We're all going to die. Okay. What did central banks do? Print. That's right, Jack.
Lebanon.
Jack and Maya, they got it. They printed money. So central banks made a decision that said, you know what? If we do nothing, it's going to be chaos. Companies are going to crash. People will be unemployed. Businesses will stop. The whole economic cycle is just going to crash. No, people will not make their loans. They will not make their payments. It's going to be like a great, great depression. So they made the choice of said, you know what? Let's just keep it going. How do we keep it going? Well, you know exactly how they kept it going. We have the perfect example in Lebanon, right?
Yep.
So the central banks around the world, they turned on their printing machines and they started printing money. Each central bank, more or less, in their own currency. In the US, for example, they were issuing checks, $600 checks to families. They printed, I think, initially $3 trillion, and they kept printing money and sending it to banks. And they tell the banks, you give people money. If somebody can't pay, no problem. Give them an extension. Somebody needs a loan, no problem. Give them money. What's the interest rate? 0%. Don't worry about it. Just take money and spend. Don't worry about it. Take money and spend. So, but at the same time, you're getting free money. At the same time, you're in a corona situation where you can't actually leave your house to spend it. So all of a sudden, you have this incremental cash balances in your account. Okay? And your job is at risk, sort of. You have this money on the side that central bank is giving it to you basically for free. Banks don't seem to care whether you're paying back or you're not paying back. Banks don't care. They're making shitloads of money. So people started buying Stocks, like Tesla at $70. They buy Bitcoin. Okay, $8,000. Somebody said that Bitcoin is going to go to 100,000. Why don't I use my $1,000 stimulus checks? I buy a bit of Bitcoin. If it goes up to 100,000, boom, I just made $10,000. Okay, so people started using that excess cash in the system and buying stocks, buying cryptos, buying NFT, I think was the last craze, buying anything they can put their hands on. And what happens when you start buying?
Value,
you must know this one. Price increases.
Yeah, but I'm thinking about the bubble now. I don't care about the price increasing. How my mind is thinking about the crash now.
But this all goes back to answer the Kathy Woods question, right? So all of a sudden, you're my neighbor and you bought Bitcoin at 7,000 and just went up to 12,000, and I'm like, whoa. You know, what the hell does Mahmoud know about cryptos? And he just made 50% of his on his money. So what do? I also have some free money sitting in my account that central bank has, infused me to actually to trade. So I go and buy more Bitcoin, more cryptos, more assets, and the stock starts going higher and higher. And obviously, you feel that like you're like a wizard. Anything you buy turns into gold, and that kind of thing, that kind of feeling, it feeds itself. I remember that feeling in '99 and 2000 during the .com bubble, and you used to buy anything which has the word fiber optics, or wireless, .com. You buy anything in the morning, you come back later, you're making money. In the end, I think I made about $70,000 in a very short period of time, and then I lost them all on one stock. But that's a different story. So that sort of operation is happening, and that is partly what is pushing a lot of these stocks and cryptos higher. To give you a statistic, I think 10 years back, 4%, I think it was 4% of the total stock market was retail investors. Retail investors are like people like us, okay? Right now, retail investors are approximately 20%, okay? So what did retail investors do? The retail investors did something which was massive a couple of months back. And you might have heard about it. You might have heard about GameStop. Exactly. GME, GameStop, okay? So retail investors, through social media, Twitter, TikTok, Instagram, they decided that they're gonna basically collude without actually colluding. They decided we're gonna collude. We're gonna start buying the stock of GME, and we're gonna go against the hedge funds, and we're gonna try to make the stock pop so we can all make massive amounts of money, okay? That's retail investors going against hedge funds. Hedge funds are, hundreds of millions or billions of dollars of professional money that is being invested. And generally, hedge funds were untouchable. You don't go against hedge funds. Hedge funds were so big that I think sometimes in the early 90s, one of the hedge funds, which was run by George Soros, nearly broke the Bank of England. Okay, that's how big hedge funds are. So, but retail investors, a few months back, decided to go against the hedge fund industry, and the hedge funds were shorting a stock called GameStop, GME. Shorting, what's shorting? Shorting means, in stocks or in currencies, you can make two bets. You can bet the stock is going up, or you can bet a stock is going down. If you bet the stock is going up, the term is going long. You'll go long the stock. So if you buy a stock at 10, if you're long the stock at 10, it goes up to 15, you make 50%. Or you can bet the stock is going down. That's called shorting. You sell a stock at 10. If it goes down to 5, you make 50%. But if it actually goes up, you lose 50%. Okay? So the hedge funds were betting that the company is going to crash, is going to go down to zero. It is an absolutely useless company, which I think they were 99% right. It was a useless company selling an outdated type of technology. But for some reason, the retail community, armed by Twitter, an account called Reddit and Wall Street Bets, They decided, they thought otherwise. They said, you know what, let's pump this. Let's get it going. In any other sort of an environment, it's called pump and dump. It's an illegal activity. But since there was no collusion, all the retail investors woke up and started doing it. They start pushing the stock higher and higher and higher and higher. It went from $17 to a high of $550. $17 to $550. Hedge funds blew up. They went bankrupt. Banks lost billions of dollars. Hedge funds lost billions of dollars. Some retail investors made millions of dollars. Many retail investors lost a lot of money. Okay. Remember something.
This is what Maya is asking. Don't you think that they were the losers of the war, especially those who jumped late on the bandwagon and bought at over $100 and held the line?
Yeah, well, she made the qualification. So she said, especially those that bought towards the end.
Yeah.
Okay. Especially those that were towards the end. Yes, they made a lot of money. Remember, in the game of the stock market, it's a net zero game, right? So if I make money, it means you lost money.
Someone else is losing. Yeah.
Yes. The company GME, even if the stock goes up from 1 to 1,000, the actual company has nothing to benefit. The only people making money are the shareholders exchanging money between themselves. So making or losing money. The company has absolutely nothing to gain.
This is where someone unemployable like myself, who in fact has an undergrad in finance, and this is why I became cynical. It's like I saw that and I was like seriously, on the one hand, I myself, as again, someone who hasn't done anything of the sort, I don't know shit. I look at it and I'm like, it's all speculation, man. No one cares about whether actually companies are making money. No one actually cares about doing business. No one actually cares about investing and making a percentage over several years. All they care about is the now, and I want to make money overnight, and I want to make money quickly, and I want to become rich. So the thought process of many people now, this is like, you have mixed messages, right? Everyone wants to make money, but it seems that no one is thinking about this gradual kind of investing in stuff, whatever it is, that try to accumulate some sort of wealth. So someone who doesn't know anything about it, I'm like, of course I'm going to be jumping on the bandwagon of Bitcoin or GameStop or anything, because I just want to make money. I want to make money now.
Okay, so
as someone who comes from this perspective, I'm like seriously, it's just a pit where people are. Because you just said it, like I exchange shares with other people, but then the company doesn't have anything to do with it, right? So
okay, so I'll tell you the issue here. So anybody who studied business or finance or economics or any sort of social science, for example, at the university level or at your training level, you are taught a bunch of assumptions, okay? And even when you're doing your doctorate, for example, you start with a bunch of assumptions, and then you tend to say, okay, the first assumption in the world of finance or in the world of economics is assume the market is rational, okay? Assume rational market, assume rational players, assume no friction cost, assume information is public. These are the assumptions behind most of what people learn in business school. Okay, and you are grounded and you are taught to think in that box.
That's why economics sucks.
Well, yeah, and then Sammy just said it's like going to the casino.
Yeah.
Okay.
And no harm in jumping in, also he said before, but the question to ask yourself is how much I can afford to lose. But then the idea is not I don't want to bet, I want to invest. This is what they teach you. These are two different things as well.
Absolutely. They are two different things. And exactly what Sammy says. And just like the casino, some games have better chances and some games have better odds, and the house tends to always win. Okay. Now in the casino, the odds are never in your favor. At best, I think it's like 49.9% or something. Whereas in the stock market, if you do things right and you tend to invest passively and you have time on your side, you might get the odds to be slightly better than 50% in your favor. But you cannot think on a short-term basis. You have to think on a long-term basis. And as he rightly said, you can only invest what you can afford to lose. And what I said was, what you can afford to lose only start after you have at least 2 years of your own savings. Only after that point of time, you can get into the investing. But if I go back to the GME story, that was the perfect example of how market dynamics just go out of the window. I'm not going to go into the Lebanese savings in Lebanon, so because that's a rabbit, that's a black hole that will never end.
Yeah, and see, this is the idea also. Jack is saying trading. We're talking about short-term trading, not long-term. Long-term, it goes up gradually. Yes, but then see. Also from the lessons that I learned from the Lebanese kind of crash, without discussing that, but it's just to abstract some lessons from it. You like, I was one of those who started thinking to himself, thank goodness I don't have money and I suck and I'm like a philosophy professor who doesn't make money, because I don't have to even lament the fact that my savings are gone, kind of, no? So, but then, does it really have to be about that? This is one, like I make enough money and then invest it in a stock kind of market and I start buying all these financial instruments? Or shouldn't we diversify even our portfolios and start businesses ourselves? What do you think about that? Because I come from a Nassim Taleb also as a fan, like, why do people now only think about, okay, I have some money, let me just put it out there in a stock market?
I am 100% in line with that sort of thinking, okay? I think the best investment that anybody can make is investing in oneself, okay? Regardless of what that can be. That is the best rate of return that you can achieve. So, in your case, for example, you invested in yourself, you've established this platform, you're writing your books, you're selling your courses, and the rate of return on that will beat any stock that you can buy once you adjust it for risk. Okay, yeah. So you have to adjust everything to risk. So if I put my money on roulette and if I put it on number 8 and I make 37 times my money, it does not mean that roulette is the best trade for me. Obviously not, because my chances of getting the 37, or sorry, my chance of getting the 38, I think were 1 out of 39. I think it is, if you look at, I think 0 or 2 zeros. So the best trade for me or to you is finding what it is that is your niche. And right now, what is our niche? We have something or this generation, we have technology that was not available to the generation which was before us. Any one of us can be a freelancer. Any one of us can be a virtual business. And that is something which is massively underestimated, okay? So it's a matter of finding a talent or finding a skill that you can actually do. So for example, it takes 3 to 6 months to learn a programming language, okay? Once you have that programming language, you can actually go and register yourself on one of the freelancing websites like Upwork.com or freelancer.com, and then charge yourself at $10 an hour or $15 an hour or $5 an hour. So no investment, no stock market can beat that, okay? So, and I think that is a massive opportunity that everybody is losing out to. A lot of even people within my firm and the people that I tend to meet, they're investing so much time looking at get-rich-quick sort of schemes, because now people's patience is nearly zero.
You even are making fun of, like, you guys, I see it all over Twitter, right? The ups and downs are like 30% a day or something, and everyone wants to make money. And
Yeah, yeah. And then the problem is, you know, there's an Arabic saying, ما بيتعلم غير من كيسه. So I can keep saying this 10 times. People only learn from their own mistakes. Okay, what's the saying? You know, a smart man learns from his mistakes. A wise person learns from other people's mistakes. The problem is there's a lot of smart people and very little wisdom. And I know from myself, I learned a lot from my mistakes. The problem is mistakes tend to get bigger and bigger, and the only time you learn a lesson is when it actually hurts. But I definitely think it's a missed opportunity. And for example, that's something which I'm doing. So why do I work on my Twitter profile, I work on my LinkedIn profile, not because I'm doing something right now, but it's an investment. I would rather invest time in building such platforms rather than going out there and buying stocks. And I'm a trader, my profession, I'm a professional trader. But I do believe I have absolutely no advantage when I try to trade in the stock market. And I tell you that as a professional trader. My chances of making it, trying to pinpoint and pick the market, are 50-50 at best. Okay, so why would you, as a non-trader, think that you have any sort of an advantage? There's a pyramid, right? Just like anything else, there's a pyramid. We are here. All of us on this call, we are right here. You know, there are companies in the US that invest hundreds of millions of dollars in fiber optic lines. Okay. The job of the fiber optic lines, it's a true story, hundreds of millions of dollars, fiber optic lines that link I think the Bloomberg or the New York Stock Exchange to their terminal. I'm not exact what do they link, what on what, but what they do is they link one point to the other. So when news comes out, they are a fraction of a second faster than the rest of the world. Okay. Why? Because that fraction of a second gives them the edge to make money in the stock market. And by the time you get the news, it has to go through people like that, and then one layer below, and the layer below, and the layer below, not to mention the private and the public and the insiders. So not insider, it's not inside. Yeah, well, insider trading is something else. But in addition to insider trading, I'm assuming in a legal world,
don't let me get into the ethics of it, please. I'm trying. There
are so many levels before you as the individual trader that by the time information comes to your ears, it has already been cooked. Okay, so don't fool yourself into thinking that I can get rich by buying cryptos. Okay, you can have fun buying cryptos, you can have fun buying stocks. Every now and then you're going to hit it. But guess what? The day you make 50% on a stock, you're going to end up investing more in the next one and more in the next one till you eventually lose it all. I'll tell you, I'll go back to my story how I lost the $75,000. I bought money. I bought into a company called Wireless Technologies. I made money. That was in 99, 2000. Then I bought into a company called Nortel. That was back in Ottawa. Made money. And then I bought into a company called JDS Uniface. Made money. I think it was about 75,000 in total. This was my second year in university.
This was you. You weren't.
This was me.
This was your.
This was me.
Okay.
This was me. This was in the lab before I go up to my course. I think it was like economics or business 202 or something. It was in the trading floor at university lab at the University of Ottawa in Canada. I put all the money in a company which my friend told me is going to make a killing. His uncle worked in the lab. This company was waiting for FDA level 3 approval for an ovarian cancer treatment. I put all the money, 75,000, into it. The name of the company was Alterex Corporation. 75,000. I was promised it's gonna easily go times 5. I'm like 75 times 5. I don't even want to compute the number. I'm set for the next few years. I finish university, boom, I can open up a business and get going. I sleep. It was me and my partner back then, or my very good friend. We put the money equally. We wake up in the morning. We look at the stock. Zero. What happened?
What happened? You're still alive, man. Wow.
One of the mice, they were doing FDA testing, right?
Shit.
And, you know, pharmaceuticals, you take enough money just for the trials. And you have to you have to patch them. one of the mice, which was going which they were doing the FDA testing on, I think one of the mice died. And then they had to put a stop to the testing phase, and the company basically ran out of cash. It nearly went down to zero. So I wake up in the morning, I see this news, and in my mind, the only thing I'm thinking about is, what if it was just a heart attack? Why do you assume it was because of a drug? Because obviously I just lost all my money. So the point of the story is, the stock market has a way of reeling you in, and you hear the stories around you of people making money till you get in the game. But the stock market is just like any other business. Okay, if you open up a small business, the average rate of return on a small business is, let's say, if it's run well, is 15 to 20%. That's what you make if you start your own business and does well.
But then let me interrupt here, because Sami wrote that a few minutes ago. Starting your own business is even a higher risk. Failure rate of startups is quite scary, putting aside the trauma entrepreneurs suffer from after failure. Few are solid enough to go back and try again. So
yeah, but see, that's why. So we're talking about the side business. Okay, we did not say leave your job and open a business. We're saying if there's anything which you can do incrementally with your money, doing something like what you're doing or building a platform might be incrementally better than the stock market. However, if you want to invest in the stock market, don't do it at the individual stock level. Do it at a passive income ETF level. Ideally, you want to create diversification. That's your ideal scenario. Okay, you do your passive investing over a period of time. You let that run its course. Don't think about it while you try to create secondary sources of income. The way to make money is secondary sources of income, multiple sources of income. That's the Warren Buffett way of doing things. But I don't know if we're deviating away from.
I think but this is good, because this is like, these are all the worries that we usually have, and I think it's also essential to point out the importance of also the fact that you can invest elsewhere, maybe, because the reason why Lebanon blew up eventually, in addition to all the other factors and blah, 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 is that people would rather just put their money in a bank than invest in small businesses, local businesses. And this is why now we're effed. We don't have any, between brackets, local businesses. So I'll ask a few questions, and then you decide which one you'd rather first, because we go back to bonds and stocks. Tariq is asking why it seems that they're inversely related. You're financially dumb and I'm financially dumber, so this is why we said this is a 101 kind of thing. So I don't know if you want to answer that or keep it till afterwards.
Bonds, which one? Who's dumber? Which one? The who's dumber one? You are me?
No, dumber. I'm dumber. This is we already yeah. Bonds, stocks. Sorry, like what should we? What's better?
Okay. So
Lebanese government bonds, probably Euro bonds would be great, right?
Yes, of course.
You were one of them. You were one of them.
Of course, all of a sudden, everybody became an expert on Euro bonds towards the end of 2019. But anyway, what is the difference between a bond and a stock? I think that goes back to some of the fundamentals. So we've explained what a stock or a share is. So basically, if you're تحياتي سامي. Sami is a mentor. And he's definitely one of the most experienced bankers you're going to see out there. And me and him, we have continuous discussions about all of these topics, where he tends to, we collaborate on a lot of these things. Anyway, so a stock basically gives you ownership in a company. When you're an owner, you tend to enjoy the upside, right? What the bond is when a company wants to raise money, you have two choices. You can either sell shares, bring in new owners, and when you bring in new owners, you dilute, which means when the company is making money, you have to spread the profits with the other shareholders. The other way of generating money is you take a loan. Okay, you can take a loan from a bank, or you can take a loan from investors. Okay, when you take a loan from investors, you issue them a bond. So let's say Decaf Quest Inc. You don't want to go public. You say, you know what? I want to raise $1 million. Let me find a bunch of people to write them a letter that says, I owe you $1 million. So you find Mazen, you find Sami, you find Maya, you find Joe, you find a bunch of these guys, and you tell them, okay, each of you gives me $250,000, and I'll give you a piece of paper that says, I owe you $250,000. I'm going to pay you 5% every year. And if I don't pay you the 5%, you come and you take the assets of my company. So I promise to pay. If I don't pay, you can take the assets of my company. That essentially is what you get when you buy a bond. Okay. Now, you can only make 5%. You only make the 5% of the bond, which is what is being promised. Now, the price of the bond can go higher or lower if your credit risk becomes higher or worse. But effectively, you make a limited rate of return. If the company goes bust, I lose my money. I go to your company, I take your chairs, I take your seats, I take whatever you have, and then I try to sell it to recover my money. Whereas a share, if your company does really well, the stock price can go from 10 to 50. I make 5x. But if the company fails, the share goes from 10 to 0. And the company will sell its assets. Who will they pay first? They'll pay first the bondholder. So the difference between the two, bondholders bonds tend to be less risky than stocks, which implies that bonds tend to have a lower rate of return than stocks. It's all a formula of risk and return. Now, this is on average. Okay, there are exceptions to the rule, but on average, bonds tend to have a fixed sort of a payment, and they have less risk compared to shares. So what do you invest in? It depends on what your risk appetite is. It depends on what your objective is, really. So it's not, there's no one size fits all type of a solution when it comes to these long-term investments.
Nader is asking or asked, what is the difference between passive investing and investing in a life insurance policy?
Well, a life insurance policy, you make money when you die. Passive investing is you buy into ETFs, as we said, and you hope that the value of the ETF or the stock goes up over time. So by the time you reach retirement, or by the time, let's say, for example, if you're using it towards education, by the time you reach education for kids, for example, or by the time you reach your own retirement, the value of that portfolio, of the passive portfolio, has grown enough in time to be able to use the funds. Life insurance is different. Life insurance is, if you have liability, if you have a family, you want to secure them in the case of death, you pay a monthly sort of a premium that says, in the event the person dies, family gets X amount of dollars.
Yeah, and I think the only difference in this case, because in both cases you're paying a premium or you're actually investing. So I'm trying to think about it from a different perspective here, is like, if you die now, you get the money whether or not you invested enough. But then when it comes to your passive investment, it's your money is whatever you put in. No?
Yes. So the payout on a life insurance policy is fixed. So let's say, for example, you say, well, I want to, X buys $1 million life insurance, and X is, let's say he's 20 years old. Okay. Let's call him Riyadh. So Riyadh buys a life insurance policy.
Not gonna work.
Not gonna.
Yeah.
Okay. Let's just kill John Doe. John Doe buys an insurance policy. He's 20 years old, and the insurance policy says that for his family to get $1 million upon his death, he needs to pay, let's say, $500 every month. What does the statistician or the actuarials in the insurance company, what they do? They say, okay, based on the life history of Joe and his family, and based on his current state, he's a non-smoker, statistically, this guy should live till the age of 85. So he's got 20 to 85, he's got, let's say, 64, 65 years to live, multiplied by the number of months. That gives you, let's say, 800 months, and he's going to pay every month X amount of dollars. So if he lives less than 85, and if he dies before 85, the insurance company will lose money. If he ends up living over 85, the insurance company will make money. So it's a very well studied actuarial to figure out how much to charge a life insurance policy.
Lives, basically.
Absolutely, there is. You know, there's a hedge fund. There's a hedge fund out of Europe. I think it's based on Liechtenstein, whatever it is. And what that fund did during before the pandemic was they were buying life insurance policies of people. So around hospitals, and they buy life insurance policies, and they'll pay you up front. So let's say you have a life insurance policy, and I look at you, I'm like, you know what, you look more like 70. And your actuarial, they think that you're going to die at 85. We think you're more like 70. So there's a 15-year differential. So Mahmoud, how about I buy your life insurance policy and I give you your money right now? So that's what they did. They were doing this in 2016, 17, and 18. And guess what happened in 2019 and 2020?
Yeah,
COVID hit.
Yep.
And all of a sudden, the profile of death went from 80 to people were dying in their 20s and 30s and 40s. And this company was making rates of return. They were 40% every year. Shareholders were like massively happy. Of course, people are dying on the other side, but shareholders are just cheering. Yalla, come on, keep dropping. So anyway,
personal ethics, you said, right? This is for me. It's like, come on, it's
Sorry if I may budge in on this point. It's
sure.
Actually relevant to what I was actually asking. That which is what I was asking about, which is the life insurance policy. But most of these policies give you sort of an opt-in option, whereby, let's say, if you aim to retire at the age of 65, for example, you can take this amount, which is give or take at a much higher rate, given that they work that money in passive investing to a certain extent. So that bit is maybe I didn't clarify my question enough, but this is where I was actually asking about that.
So another, right? So these policies are a hybrid. Okay, so it's an insurance policy which has built-in.
We lost you.
Hello? Okay, I'm here. Cash surrender value, which I believe that's the name. So at a certain point in time, the money that you're putting monthly, part of it goes towards the actual life insurance policy, part of it goes towards an investment savings plan.
They position it as sort of a retirement plan to a certain extent, but it's more relevant to what you're saying. Exactly.
Yes. Now, these things, I rather do them separately. So I have, for example, I have a life insurance policy which is separate, and then I have passive investing, which is done through interactive brokers or Saxo Bank, which you do your passive investing, and then life insurance you do it separately. I believe the cost is better. You diversify among two. In the end, think about it. You're investing in a company. Exactly, as Sami said, the fees on these are killer. So it's always better to get them separate. You do your own ETF separately. You don't pay the high management fee, and then you buy the insurance policy just clean from insurance policy with none of these gimmicks attached to them. The more the gimmicks, the more that you're paying, even if they tend to tell you otherwise.
Thank you, Mazen.
I'll keep on asking questions. There are questions around, so let me go with Zakia.
When are we cutting this off? What do you think?
We can go until just it's you and me. So I don't know. Let's go at least over the questions, because there are interesting ones and people are getting more excited and asking.
Okay.
So let me just do that. And this is I'm facing the same issue, even though I don't look at any investment shit. But over YouTube, you keep on getting these technical analysis shit all over the place. how can technical analysis be reliable if everyone can use the same method or software, blah, 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 you know? So technical analysis.
So technical analysis is good as long as other people use it. Okay, so I'll give you an example. Let's say there's 50 of us on the call, and then the 50 of us agree. 50 of us agree that if we wake up tomorrow and the sun is shining, we're gonna buy Bitcoin. Okay, and let's assume the number of people in the world is 90. Okay, so number of people in the world is 90. There are 50 of us on this call that have access to Bitcoin. And we all agree today that if we wake up tomorrow and the sun is shining, we are all going to buy Bitcoin. We wake up tomorrow morning, the sun is shining. What do you think happens to the price of Bitcoin?
I don't want to go all philosophical, so I'll let them answer that.
Exactly. There's no philosophy.
There is.
So
I'll get some Hume in, and then I'll make you doubt whether or not the sun will rise tomorrow.
So the price of Bitcoin, when it comes to money, the price of Bitcoin will go up. Okay? So the price of Bitcoin will go up because the majority of the market seems to think that the sun has become the indicator for the price of Bitcoin. Now, technical analysis is to a certain extent based among similar principle that we historically have seen that around this level, people tend to sell, and around this level, people seem to buy. That bottom over here is called the support. The top is called the resistance. Okay, so as the price of the stock comes closer to here, historically, we feel resistance and people tend to sell it. And more people start to believe that as it gets close to resistance, people start selling it, which drives the price lower till it comes to the support. And around the support, people tend to look at the chart and they see, oh, look, when we go back, it seems to get support here, so let's buy. So technical analysis looks at past history and tries to tell you where the stock might stop, where the stock might go. Now, it's good. It is a very useful tool that when you decide to buy a certain security, you can use technical indicators to figure out when is an optimal time to enter and where you should think of exiting. But technical indicators do not actually impact the value of what you are buying. Now, the world, however, has advanced greatly. So one of my best friends from university, he's a PhD in mathematics, PhD in engineering, and he works at the largest hedge fund in the world. What he does is he goes through all sorts of technical indicators and he writes programs that tell him that because of these technical indicators, people are going to start selling at this resistance and they're going to start selling at this support. So my program will start selling just before you and it will start buying just before you. This way, given enough time, the support and the resistance will no longer be of value because the machines will outsmart the individual. And all of a sudden, new indicators will actually kick in. So they are good for a short period of time as long as other people use them. The moment people stop thinking about it, and that's why there are many technical indicators, right? You look at the same stock, some people might tell you head and shoulder formation, some will tell you it's an upward channel, some will tell you it's an Elliott wave, others will call it a Fibonacci, whatever. Okay?
Useless models.
It's not useless. I think it's a way when you're wrong, you can say the model was wrong, not Mazen
of course,
was wrong.
that's exactly
right.
You want to blame it on something else.
Absolutely, absolutely. Because you know what, when you get it right, I was too smart. I managed to get it. When you're wrong, the model failed me. So that's why you need all these things plus the legal liability.
Indeed, which is but that's for a different kind of sessions about the legal liability. Laura is asking ETF like Dow Jones, and how safe are ETFs? Joe is asking.
So ETFs, they are. Let's see. So ETFs might be extremely safe. They can be extremely risky. Like something like an ETF that invests in like nanotechnology, for example, or ETFs that invest in mining stocks in Brazil, they might be extremely risky. But ETFs that invest in like the Nasdaq, or they try to mimic the return of the Dow Jones or the S&P or the global or the European market, these ones are extremely safe. Now, how to choose the safe ones? Go for the names. BlackRock, Vanguard, names as such are the safe names. So first you want to go for the brand name, like the Vanguard or the BlackRock or the equivalent. Then you want to go for the industry that you're targeting. So if you're going anything which is like global European markets, North American markets, automobile industries, airline industries, any of these ones are extremely safe to get into. A very basic research, if you go ETFs, you can do a very basic research, and the basic research will tell you the safety of them. Most importantly, when you look at ETF, you have to see how much they charge you. ETF should not charge more than 0.3% or 0.35%. And you have to see how much assets under management that they have. So if they only have assets under management of 100 million, that's very small. They need to have billion plus to make sure that there's adequate liquidity in the ETF in case you need to buy and sell.
And I'll jump a few questions, but if Jack is asking if someone is solvent in cash, what is your advice on investing long-term right now? Entering the market, fearing a bubble, what would you suggest doing with it? And I can tie it with Maya's question about whether or not bonds and stocks are equally risky, perhaps.
Okay, so I cannot tell you what to do, but I can tell you what I'm doing. Okay, and obviously circumstances are different.
Kind of stuff.
Circumstances are different for.
Show us your portfolio, man.
Well, it's quite boring. Because I think portfolios are not supposed to be entertaining. I think they're supposed to be a safety net. I think the best thing you should do, look at, which is generally what I do. There's a guy called Ray Dalio. If you don't know who Ray Dalio is, write that name on a piece of paper. Ray Dalio. Ray Dalio, Bridgewater.
He's in there, yeah. No, but yeah, Bridgewater. The book is interesting, Market Wizards.
Yes. So Ray Dalio is the owner of the largest hedge fund in the world, which is called Bridgewater, which is the fund where my friend that I spoke about earlier works at. And he has basically a fund called the all-weather portfolio. What's an all-weather portfolio? All-weather portfolio is a portfolio that should do well regardless of the market weather. You know, whether you're in a bull, whether you're in a bear, stress scenario, etc. The all-weather portfolio. He doesn't enslave his employees. They're all multimillionaires. I guarantee you, they are all multimillionaires.
Bull and bear as well. You wanted to discuss these?
Yes. So what he has, and other people have as well. They've devised some sort of portfolio which has a breakdown between stocks, bonds, commodities, and cash. That should give you an average rate of return, let's say between 7 to 9% over a period of time. So that is number one. So number one is look at some portfolio as such. Number two, the most important, so you don't have to worry about the timing the market. And if you have cash, then commit a monthly amount of money to be invested in that portfolio. That is what I do with the money that I cannot afford to lose. Okay, now obviously with the money that I can afford to lose, I gamble, as in buy and sell stocks and cryptos for the purpose of making money, losing money, or having a social discussion with Sami about. But otherwise, when it comes to the serious money, it's very similar rate value sort of passive trading on a regular monthly contribution.
Yeah. He's also become some sort of mentor to the hip hop people, P Diddy, and these guys are listening to him to try to, you know.
Well, I think he's worth about maybe $30-40 billion. So I think he's a bit bored.
Yeah. And so he's also featured on the Market Wizards book.
Yes.
This has also been interesting for me, like many philosophical views there.
He has a bunch of books. I think anybody who wants to get serious about investing and trading, I think he needs to go and they need to read one of his books called Principles, among others. And there's a weekly commentary that you can actually sign up to. It's free. And it's just great information.
Bond yields increase. Is asking, the stocks and indexes go down. Is it just migration of capital?
Yeah. So money goes to where adjusted return is better, basically. So when interest rates tend to be close to zero, people don't want to leave their money in the bank. They want to move it to the stock market. And when interest rate goes higher in the bank, or for example, what happens? People will sell their stocks and move money back to the bank to earn risk-free sort of return.
Higher, how much is that? 15%, like we had here?
No, but banks.
Yeah.
So what happens to the bond dynamic?
So many people knew about all this. Why were people who worked in finance and shit take out money and loans and put it here? And Lebanese are smart asses. It's like, no rationality.
Because it never failed before. Yeah. Because it never failed before.
Yeah.
Anyway, yeah, that's a never-ending topic. Okay.
Are you betting on the EM or on US?
Well, diversification allows you to do both, right? So right now, I think I'm approximately 30% US, more actually, 40% US, 30% EM, and the rest is like bond and cryptos, is my overall passive portfolio.
Bond and cryptos?
Yes.
Cryptos, like which free was it? What was it? Free coin.
Free coin. Well, I think there's enough. There's too much free money in the system and too much free time on the hands of some people. Remember, casinos are closed. People can trade or wager on their mobile phones. Everything's done electronically, and it takes now a few hours to open up a trading account. So, and the retail money is a lot, and it's active. So all of this has room to trade. So whether it's Bitcoin, Ethereum, Cardano, Storj, Freecoin, you name it, there's a saying that a rising tide lifts all ships. Well, right now it's a rising tide, so you just buy any little ship and should be okay for a period of time.
Zakia previously asked whether Bitcoin has value.
I have absolutely no idea. All I know is it's making money. It's making me money.
It's making you money.
That's for now. I think yeah. But does it have any value? I think JP Morgan came out with a valuation. They said it's going up to $146,000. I think some like Guggenheim said $300,000. I heard somebody today say $1.6 million. In reality, it'll keep going up as long as people are buying it. But the moment Elon Musk comes up with a tweet and says Bitcoin's go back to Earth, this thing's going back to 5,000. All right, the same way he did Dogecoin.
Yeah. And Matthias Tau is asking, that's a question to you, whether or not you give classes.
This is a class.
Probably he wants a hardcore kind of non-OSB class.
I don't think there's any information that I have or that I know that cannot be found on a very simple Google search. I think.
Let me put it.
I know it's. I know people the convenience. I understand
people,
the value of convenience.
People are paying for philosophy courses, man. It's like if people pay for philosophy courses, then they would pay for absolutely anything. It's like if I am monetizing philosophy.
Yeah. To answer this question, I think it's something you and me, Mahmoud, have to discuss at a later stage. Whether we can
no, but you yourself, why don't you give classes? Like, are you not teaching at a university or something? You told me that you.
Yeah, I teach at local university here, but in terms of doing like one-on-one classes, I don't think it's something. But I think if he wants to reach out, like I think Matthias, I think he's on either LinkedIn or Twitter. Then maybe we can get together some groups or something, and I can assist where I can.
Yeah, you need to do some pre-recorded stuff.
Yeah.
What about interest rates or blah, blah, blah. What about SPACs at the moment? I don't have what that is given the trend of 2020.
So SPAC, it's a new takeout delivery item where. No. So SPAC, it's something called the Special Purpose Acquisition Company. Okay. Basically, what it is you write a check to a company, and you have absolutely no idea what the owners of this company are going to do with the check. The money goes in trust, and the purpose of this company gets listed on the stock exchange, and the purpose is this Special Purpose Acquisition Company, which is already a listed company, public company, will go and find a private company. So if Decaf Quest Inc. wants to go global and you want to become a public company, instead of going to Goldman Sachs and doing the whole IPO process, due diligence process, which might take months, and trying to find investors, you go to a SPAC, which is already listed, already funded, and the SPAC will buy you, and you automatically get absorbed by the SPAC, and within a couple of weeks, you become a listed company. So all it is, it's a fast way of getting listed. That's it. And it has a cool name, SPAC. And I think now it's been around for, I think, 10 or 20 years. It's definitely not a new concept. I think it's gained the new momentum on the last couple of years because people have no patience to wait. And that's how Anghami went public, right? So it was a SPAC that acquired Anghami, and then it became public. It was through a SPAC. Is the short answer.
Okay. There's this thing I did a few weeks ago, which was it's something along the lines of I don't know if you know Republic company. It's invest in startups. So what they do is some sort of crowd investment, but then you don't actually buy shares. You just invest. You buy, like, let's say you put in $100, which in case they will eventually go IPO, you will become a shareholder.
Okay.
Yeah.
So this is basically so let's say in financial terms, it's a convertible debt.
Yeah.
So you're lending them money, and in the event they go public, instead of them saying we owe you like a bond, we owe you $100, we're gonna convert the $100 to shares in this company. So if we do really, really, really well, you're gonna make a lot of money. Basically,
yeah.
That's what a convertible loan is.
Which I didn't really get because the SEC, or I don't know who in the US, changed how things are being done. So it's in a way you're just basically crowdsourcing investments without having to go through the angel investors and stuff like that. I don't know. So
yeah, I think that's one of the risk of crowdfunding. The risk of crowdfunding. Basically, if I want to raise $1 million, I can either go to two people and ask them for 500,000, but these two people are going to end up being extremely smart, extremely shrewd, They're going to ask me for much better terms. They're going to ask to go through my bio. Who's Mazen? What the hell is he doing? What's his company? Talk to me about your presentation, blah, blah, blah. Obviously, because they're investing $500,000. Or I can go to 100,000 people and ask them each for $10, the price of 2 cafe lattes, right? Who's going to ask more questions? If I have solid presentation skills and I want to raise $1 million, I'm just going to crowdfund it. I'll have a nice video. I'll have a nice story. I'll ask for the $10. I promise you convertibility when my company goes public. Okay, sometimes it might work, but companies that tend to crowdfund are those that can't really get money by finding strategic investors. Just keep that in mind when you put money in crowdfunding.
Oh yeah, no, it's not even that, and this is the other idea, because in my case, so for example, without getting into details, Gumroad, you see it growing for the past maybe 5, 8, 6 years. You are putting your work there and selling it as well, so you're like, okay, fine, I want them to grow. So it's that kind of synergy between creator and company. So creator economy. That's something people should look into as well. For monthly contribution, do you do it regardless of the equity price, or still try to buy low?
Absolutely. The whole point of the monthly contribution is not to worry about timing. If you look at stock market returns over a long period of time, let's say even in a single year, you're going to find the stock market goes like this, and then you're going to have like a day like that and a day like this, etc. So if you try to time the market and you miss 1 or 2 of the big days in the year, I think your average rate of return will drop from like 9% down to 2%, because those 2 days might be like a 3% days, for example. So the whole point of passive investing is to do it monthly. This way you eliminate that random risk of missing an up day or a down day. So choose a day, 15th of the month, or let's say your salary comes on the 20th, on the 21st, make that contribution, close your eyes and just don't think about it. The only thing you want to think about when you're doing passive investing is, let's say, when they are on a quarterly basis or an annual basis, you want to rebalance. What does rebalance mean? Let's say you decide that the perfect fit for you is, let's say, 70% stocks, 30% bonds, and your portfolio is, let's say, $10,000. So you have 7,000 in stock, 3,000 in bonds. At the end of the year, the value of your stock has gone up to 8,000. The value of your bond has gone down to 2,000. Let's say the value of your bond has gone up to 3,000. So your portfolio went from 10 to 11, but now the composition is 8-3. So it's no longer 70-30. You want to keep that 70-30. So you sell a little bit of your stock market, a little bit of your stocks, and you buy a little bit of bonds. So you maintain your allocation at 70-30. That's the only thing you should do. And the best stockbroker, Maya, I'll tell you who I use. I use Saxo Bank.
And I'll get to that because I don't know where they are based, but I want to ask in regards to the rebalancing. Interest rates are going to increase. Also, Maya is asking inflation to increase as inflation is increasing, along with other factors. Don't you think bonds is the last place you would want to be now?
No, because I think that argument or that discussion is still ongoing. I think the Fed has made it clear they're going to keep rates basically on hold. I think they have many ways and many pillars to be able to control it. So no, I don't want to stay away from bonds. I like the constant yields that they provide. I don't worry about short-dated mark to market. That's the whole point of doing passive trading. So no, I like some of my bonds paying me 4% or 5% on a semi-annual or on an annual basis. So even if the price goes up or down, I'm gonna average out through a bond portfolio over a period of time. So I don't tend to time. Now, from a trading perspective, that's a different story. Yes, as Sami said, they are based in Denmark, a regulated bank. I think they have some kind of. I think Sami, what's the protection? Is it 100,000 or 500,000 on deposit insurance?
See, but you're always, yeah. These are for people who have more than, I don't know, 60K, 70K.
No,
80K.
you can open up, yeah. Okay, so you can open up a Saxo account, I think with
$10K.
$2,000.
No,
and
10. In Lebanon,
10,000.
It's 10. I saw that.
$10,000. And I think it was one of the easiest ways. And when I was recommending some of my friends and family members a couple of years ago to get out of Lebanon, one of the easiest ways to get out of Lebanon, get your money out of Lebanon, was to open up a Saxo account. It's an online, Lebanon. Yeah, and it's an online account. You open up the account remotely, and you open an account, transfer the money, and boom, you're in a Danish bank that gives you access to all sorts of investments and all sorts of trading activities. So it's not as difficult as people tend to think to move your money offshore.
Yeah, well, it's.
Well, now forget it. Now it's
no. But irrespective of the money, it's good to know that this, because other platforms, it's been difficult for me to try to. But US based and takes a while to open an account. Yes, exactly. I tried interactive brokers and it's not that cool. But they don't have a minimum, kind of. That's the difference. What do you think of? Yeah, tell me.
I'm saying, shall we cut it off at like 11:30? We'll just keep it at 2 hours.
In your case, yeah, sure. We can go on. We can wrap it up.
Obviously.
Well, or not. What do you think of dividend versus growth portfolio?
Well, it depends on the profile of the person asking.
I don't know what the profile, Jack.
So okay, I put it. Yeah, growth. I'd go a higher weight. If I have to choose, I'd put a higher weighting on growth portfolio versus dividend portfolio. If these are the only two choices, gun to my head, which one I'd go for? I'd go for growth.
And
all else being equal.
Eliane is asking about crash bubbles when the globe is going to go back to working normally, the market will crash.
Well, what's working normally? I don't think anything is going to go back to working normally. I think the world will end up becoming a much more efficient world. I think you're going to see much more consolidations. You're going to see much more mergers. I think everybody's going to start working smarter. Technology, robotics, AI are going to take over human roles at a record pace. So yes, there might be corrections, but I don't think, there might be bubbles in certain areas, but overall, I think the state of the global state of the world will manage to pick up. What's the Fed's doing, or what are central banks doing? Central banks are printing money, printing enough money, waiting for global economy to pick up. So the objective here is let us support the world. Let's put enough injections in the system to keep the world going till it can reactivate on its own. Once the world is reactivated and GDP is growing again, then the market can pay us back. Okay, that is the whole proposition here. That's exactly what central banks are doing. So is it going to work? Well, they're going to keep pumping money till it works, right? What do they say? Well, why does the Indian rain dance always works? Because they don't stop dancing till it rains. I think it's going to be like a similar scenario with central banks. They're going to keep pumping till the economy can float.
As also Sami is saying, don't invest in commercial real estate and office space.
Well, yeah, absolutely.
COVID is the Trojan horse. Yeah. And depends also on what you're trying to invest in. But then if you were, and this is something else. If you were to start a business or to invest directly, put your money in a small startup or something.
Yes.
What would you invest in currently?
Okay, I'll tell you what I invest in currently. If I were to lose my job tomorrow due to something I may or may have not have said on this call, this is an honest answer. I would invest in a Lebanon or Egyptian-based economy, and I'll tell you which model that I would apply.
Which one? Sorry.
I'll tell you what sort of business type I would apply. Okay. I would outsource services based out of Lebanon. I'll give you an example. I think it was a few months back. Somebody I know was looking for somebody I know in Dubai was looking for an assistant. Okay, and in Dubai they were, I think, for a personal assistant, let's say you pay around close to, let's say, maybe $1,000 maybe, or something like that per month, so $1,500. Okay, a customer service might get a little bit more than that. So they end up recruiting somebody that can do the same sort of a job from Lebanon for 20% of the price. Again, I have the same experience now. So I have my daughters are learning Arabic with Arabic teacher in Saida. So we pay her a fraction of if we were to get a teacher here in Dubai, for example, or anywhere else in the world. The service is much better. The quality is much better. There's the cultural understanding is much clearer. So there is massive price arbitrage between some of the services that are offered, for example, in Lebanon, or I'll have to add Egypt, although Tariq Raghab might disagree on some of my fundamental economic theories about Egypt. But there's massive mispricing. There's a massive demand to quality. So you take the average Lebanese. You have language, you have customer service, you have ability to understand your culture, that can sell you anything from a tire to a Louis Vuitton bag, right? They can cater to any person or any retail customer on the spectrum, from the poor to the ultra rich. That is something which you can compete with China, you can compete with India or Malaysia. So what I would do, I rent the building, staff it with quality customer service, quality personal assistants, quality programmers, quality designers, and figure out a way to interface to the rest of the world and make that price arbitrage. It'll certainly make me a lot of money. It'll certainly make them money. And most importantly, the client will have a much better service at a much reduced price. That is what I would do. That's what I would actually invest in.
Yeah, but ultimately, as Tariq is saying, you need fiber optic and kahraba for these services on large scale.
It's very basic. No, I know Egypt very well. Tariq, I think Tariq left Canada in 2000. Tariq, you left Canada in 2005. Egypt, how long have you been on this? How long have you been on this Zoom?
This is a different Tariq, but who's Tariq?
Okay,
okay, not me. But I still.
Tariq.
Yeah,
but
that's the only thing I disagree with on you.
the Egypt part. Okay, but or the fiber optics. But okay, let's take a live example. I don't need to prove it further. We've been on this call for about 2 hours. We have how many people on this call?
Now 24.
Okay, we have 24. We've been talking for the last 2-ish hours. Other than the admin mistake that the unemployable philosopher did at the get-go, we've had absolutely no issues.
Yeah.
So
I'm using 4G though.
I'm using my mobile phone, whatever I'm using. So with very basic infrastructure, we've managed to have a 2-hour discussion. So why can't? Yeah. So why can't a salesperson or a customer service rep sitting somewhere in Lebanon do the exact same thing with slightly better infrastructure? So no, I think it's certainly. I definitely think it's doable.
See, yeah, but even what I disagree with, and that's my comment, and we'll wrap it up, is is that this idea of always trying to centralize stuff, like why not, and paying them much less. I disagree on that as well for some reason. It's like, I know, why not pay them like 80% instead of 20%?
Well, I'll tell you why, because a market is supply and demand. If let's say for example, I'll take your argument. If I pay them 20% and they're doing a great job, tomorrow Tariq might say, you know what, I think this is a great business proposition. I'm gonna do the same thing. I'm gonna pay them 30%, and they end up doing well. And the day after, Amr says, you know what, I think this is great. I think Tariq is underpaying them 30%. I'm gonna pay them 50%. So you know what, I'll start with a number. And if my theory is right and the business works, the value of the business goes higher, and the value of every person along that business chain will go higher with it. And that's where you reach market equilibrium. Guess what? If I start you at 20%, and if my business fails because that 20% is not working, the next person is going to pay 10%, and eventually they're going to pay zero. Okay, so it is a bidding process, just like any other asset. Okay, we have to take out emotions to a certain extent out of the game, and think about
it will cost you much less because you're just paying, like, consider it a part-time position, right? So many other companies I'm seeing now, again, I'm using Gumroad, because I'm a Gumroad fan. It's an online platform where you can sell digital products. This is where I'm selling my courses and everything else I'm basically doing. So they now decided to just, they don't have meetings, they don't have anything. 25%, like, you just work 2 hours a day. I don't work with them. I'm not but for them, those who run the company, and they pay the same across the world, and it seems to work. So it's interesting to see that, like, things are just, for some reason, when it comes to Lebanon, it seems that people are always like, they want to have you in a certain place at a certain time, etc., etc. Why not just go with the flow and let things a bit more decentralized in that sense?
I'll tell you something. I believe you take out what you get in. So let's say, for example, how I do my job. The way I do my job, my company pays me X. I put in 0.9 of X, let's say. Okay, I'm hoping nobody's Standard Chartered is on the line. But if my company pays me X, I'm a trader, right? And I think everything in my mind goes back to dollars and cents. So if you're paying me X, and I believe my rate of return is 10% a year, I'm gonna put in 0.9 of X. Otherwise, if I'm putting 1.1 X and my company is paying me X, then I'm losing money on this deal.
Yeah.
Okay. So it is the same thing that when I said 20% Lebanon, I'm just throwing a number, but you gotta start somewhere.
Of course, right? But you can make it like work 2 hours. Like in this case, I can understand it. Like work 25%, you're saving on insurance and other stuff.
Absolutely.
Take the money and
office.
And so far as you're doing the work, I don't care what you do with it. Just service center. Yeah, but then you said something about coders as well, not only customer service, like from what I gathered.
Yes, anything. That's why I told you initially, like anything that you can learn that you can apply remotely is something which you can sell. And realistically, I know realistically that is the real way to regenerate a real economy in Lebanon or any of these markets. So for example, sometimes when I need research done extremely quickly, extremely good, for example. So there was one time I wanted research about South America. I didn't go to Google. I went to Upwork.com. I found a PhD. I think he was in Colombia, and asked him for an economic research about, like a quick economic research about Colombia. And I think he charged me $7 an hour or something like that, right? If I were to ask somebody in London or New York to do the same thing, they would have said, I want $200 an hour. Same thing now in Lebanon. It has to be competitive because all these skills that we're talking about, you're competing with Pakistan, you're competing with Philippines, you're competing with India. India is 1-something billion, Pakistan is in the few hundred millions. So it has to, you need to realize who we're competing with. We never competed with Europe, Anyway, okay, off topic.
No, but it's not the salary. All I'm saying is the problem is like give people more liberty. I see that the kind of fixing the number of hours I've been seeing all these job posts instead.
Yeah, everybody is going towards that flexible working model
stuff,
and yeah. All of a sudden,
they can do several gigs at the same time, and they can be fine.
All of a sudden, companies now have become human, and companies have all of a sudden started to care.
It's not motivated. It's not motivated from we need to pay them more. It's not that. It's just that if you're going to be paying them much less, they might as well just do the work flexibly and then do stuff with it. They can generate more. They can do all sorts of stuff. And as I said, as someone who just had who's doing philosophy, I've been able to Upwork.
Upwork.
Oops, no. Not that. Upwork.com. Autocorrect.
Yeah.
So, but see, another problem is, I don't know if Upwork now works in Lebanon because they stopped the payment, the digital, the payment gateway, digital Payoneer. They used to Payoneer for the philosophy classes, Gumroad. But see, this is the thing. And I'll end with that, because those who are based in Lebanon, the reason why I can do that is because my wife is Argentine and she has a PayPal. So other than that, I'm fucked. Anyone who thinks companies are human or really care about diversity, no, I agree with you, but it wasn't coming from that. I'm strictly free marketer in that sense. But then, it's like, and that's something to think about. And I've been telling people, look into digital kind of wallet kind of thing, because there are so many people around here, they don't know how to get paid. And had it not been for me to be able to have a PayPal, I'm literally fucked. Meanwhile, because the majority of I've tried, it's you like Gumroad doesn't do that. Upwork doesn't do that. So it's very difficult to find a platform whereby you can freelance and get paid in a way, depending on which platforms they support. So look into that. Many people have been complaining. The money is all there. So we're effed there. But look into that, because many freelancers in Lebanon have been complaining about this. So how can we be paid? You are in Dubai, okay, fine, you can transfer money, but then with the world, I don't know.
And let me tell you something.
The participants, by the way, and the courses have been from across the world. It's so if I didn't have that, I would be just here being unemployed.
When it comes to money, there's always a way of getting it from point A to point B.
Which is what I did, of course, but then not many people might have the option. So that's a business, as Carol is saying. Maybe the next investment should be in
I have a very easy solution for you. I can tell you afterwards.
Not myself. For those who don't,
you're sorted.
I'm sorted out, man. I care for the others. I'm like, you can do business online.
There is a very easy solution, which I think people just need to think a little bit. What's the right word? Opportunistically, and there's an easy solution for that in a very, 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 very close by banking center. I'll leave it at that. Otherwise, tomorrow I'm going to have to start opening up a data center in Lebanon for outsourcing services.
Okay, do that. So this, I don't know if this how this went or if this is a thing of interest for people to keep on hearing about more details. I've definitely learned a lot, and thank you for doing this. And
thank you.
Final words.
Well, I definitely I definitely enjoyed speaking, but and the interaction. I think we got some really nice interaction going on. So thank you everyone, and I think we'll see. Like I think maybe we can check some feedback later on, and we can decide whether
you want to say about the community thing. No.
That's right. So what the purpose, like a secondary purpose of this discussion was just to raise awareness about some of the projects that we're doing in Lebanon. One of the projects is called Sallat al-Khair, whereby we are collecting food baskets and distributing in Saida, which is the community that I'm from. So I don't want to make a big issue out of it. You can, I think, if you follow me on Twitter, you might have seen me doing a lot of posts about, we've been distributing for about a month or so. So for anybody that's that got any value or that would like to make any donation, regardless, would be more than happy to accept. The donation will be going to Decaf Quest, and then he'll be sending it directly. So nothing will be coming to me, through me, or for me. Okay, absolutely no obligation. But what I would like is, if you did enjoy the session, and if you think there was some value out of it or any feedback, if you can share that with Mahmoud, that will be great for us to know, to see whether there's a point of doing this maybe on a more regular though infrequent basis, or when some like nice topic come up in the market where people would like to know more about it, then we can do it on an ad hoc basis.
Non-Lebanese related.
Yes, not Lebanese related. I think that's been already done and dusted with. Yeah. But thank you very much for taking the time.
Thank you for joining, and I just shared the link there, and I'll be sharing this later if he doesn't or hasn't regretted this already. So have a good night and see you around.
Yeah. Bye-bye, everyone.
Ciao.